There are days in the market when nothing works. I don't care how sharp you think you are or how clean your chart looks. The tape has a way of humbling every man who thinks he has it figured out. I learned early that trading is not a straight road upward. It's a crooked street with more false turns than honest ones. And when you find yourself losing trade after trade, you have to stop and ask yourself a hard question. Is it the market that's wrong, or is it you? Most traders, when nothing is working, do the worst possible thing. They do more. More trades. More size. More noise. They think activity will rescue them. But the market does not reward motion, it rewards judgment. You ever notice how the biggest losses often come right after a trader starts forcing trades? That isn't bad luck. That's impatience wearing a clever disguise. When I was coming up, I learned to respect dull markets and bad streaks. Not because I enjoyed them. Nobody does. But because they were telling me something. The market always speaks. The trouble is, most traders are too busy talking back to listen. When your trades stop working, the first thing you must do is reduce your exposure. Not tomorrow. Not after the next setup. Right then? Because capital is your inventory, and a man who burns his inventory has no business left to run. Think about your charts for a moment. When a stock refuses to follow through after a clean breakout, what is that telling you? When your winners stall and your losers move fast, what is that telling you? The market is not a classroom. It doesn't explain itself twice. Weak follow through usually means weak conditions. And weak conditions are where overconfident traders get separated from their money. Now, here is something most fellows don't like to hear. Sometimes the best trade is no trade at all. Yes, sitting on your hands. Sounds simple, doesn't it? But if it were easy, more traders would still have their accounts intact. The truth is, inactivity feels like failure to the undisciplined mind. But to the professional, patience is a position. When nothing is working, stepping aside is not retreat. It is strategy. You see, the market moves in phases. There are times when trends run clean and profits come almost too easily. Then there are times when the tape chops sideways and eats up both bulls and bears. Do you really think the same aggressive tactics should be used in both environments? That's like bringing a racing car into a swamp and wondering why you're stuck. Another mistake traders make during cold streaks is changing systems every other week. One loss and they abandon their method. 2 losses and they're hunting for a new indicator. 3 losses and they're buying someone else's signals. Does that sound familiar? The market punishes inconsistency. If your method has an edge over a large sample of trades, then short-term pain is part of the business. But if you never stay with anything long enough to measure it properly, how will you ever know the difference between normal drawdown and real failure? Still, let me be clear about one thing. Stubbornness is not discipline. There is a difference. If your charts show clear evidence that market conditions have changed, you must adapt. For example, when volatility contracts and ranges tighten, expecting big trend moves is usually wishful thinking. When volume dries up, breakouts often fail. Are you adjusting your expectations to what the tape is actually doing? Or are you trading what you hope it will do? Money management becomes your lifeline when nothing is working. This is where the serious trader separates himself from the hopeful gambler. During losing periods, your position size should shrink automatically. Not because you're scared, because you're professional. A good trader thinks in probabilities over time. He knows survival during bad periods is what allows him to capitalize when conditions improve. Let me ask you something straight. How many traders blow up not during bull markets, but during choppy, uncertain ones? More than most people realize. Because confusion breeds overtrading, and overtrading quietly drains accounts faster than one big mistake. That's why your job during rough patches is not to prove you're right. It's to preserve your capital and your clarity. When trades stop working, the first move is to trade smaller, not smarter. That may sound backward to the fellow who thinks harder thinking will pull him out of trouble, but the market does not reward effort the way a day's labor does. The market rewards alignment. And when your trades begin to misfire, the problem is usually not that you need to outthink the tape. It is that the conditions have shifted and your risk is now too large for the environment you're operating in. Most traders make the same costly mistake. The moment they hit a cold streak, they lean forward in their chair, tighten their jaw, and tell themselves they just need to be sharper. They add indicators. They zoom into smaller time frames. They start hunting for the perfect entry. But tell me, have you ever noticed how often that only makes things worse? Because when your judgment is under pressure, complexity becomes your enemy. I learned long ago that when the market stops paying me, my first responsibility is not to outwit it. It is to protect my stake. A trader without capital is like a merchant without inventory. He may have all the clever ideas in the world, but he has nothing left to sell. That is why position size is the first lever you pull when performance slips. Not because you are afraid, but because you are thinking like a professional. You see, the market moves in seasons. There are periods when breakouts run clean, trends stretch far, and momentum carries your trades forward with very little friction. During those times, normal position size may serve you well, but then come the other periods, the ones that frustrate even experienced operators. When the tape turns choppy, follow-through disappears, and price moves begin to stall just when they should accelerate. Do you really think the same bet size belongs in both environments? A smaller position during uncertain conditions does two important things. First, it limits the damage while the market is behaving poorly. Second, and this is the part most traders overlook, it preserves your emotional clarity, because once losses begin to feel heavy, judgment begins to blur, and blurred judgment is far more dangerous than any chart pattern. Have you ever taken a loss that was just big enough to irritate you? Not devastating, just enough to sting. What usually happens next? Most traders try to make it back quickly. They press, they force, they start seeing setups that weren't there 5 minutes earlier. That is not analysis. That is emotion wearing a technical costume. And it is precisely why reducing size early is so powerful. It keeps the losses small enough that your mind stays steady. There is another truth the market teaches, though it teaches it expensively. Streaks cluster. Winning streaks and losing streaks both tend to run in groups. When your trades begin to fail one after another, probability alone suggests you may be in one of those unfavorable stretches. Now, you could fight that reality, or you could respect it. Which do you suppose keeps traders in the game longer? The professional understands that survival during the dry spells is what allows him to press during the fertile ones. He does not need to prove anything to the market on a slow week. He does not need to win every day. What he needs is staying power. Because the big money, the real money, rarely comes from forcing trades in poor conditions. It comes from being properly positioned when the market finally opens the door. And here is something else worth considering. When you reduce your size, you create room to observe. With less money at risk, your mind becomes more curious and less defensive. You begin to notice things again. The way volume behaves, the quality of follow-through, the character of pullbacks. But when you are trading too large during a drawdown, your attention narrows. You stop reading the market and start reacting to your P&L. That is a dangerous shift. Many traders believe confidence comes from increasing size. In my experience, the opposite is often true. Real confidence comes from control, from knowing that no single trade, or even a string of trades, can seriously damage your account. That kind of confidence is quiet, steady, and durable. It allows you to wait. And waiting, in this business, is often where the advantage hides. So when nothing seems to be working, resist the urge to become more aggressive with your thinking. The market does not pay bonuses for intellectual effort. It pays for timing, discipline, and risk control. Shrink your size. Watch the tape. Let the market show its hand again. Because the trader who survives the difficult stretches with his capital and his composure intact is the one who is still standing when the real opportunity finally appears. Your mindset must stay steady when your equity curve does not. That is one of the hardest lessons in speculation, and it is the one most traders only learn after paying the market a painful tuition. You see, the market has a peculiar habit. It tests your emotional balance long before it rewards your technical skill. A man may read charts well enough, may understand trends and pivots and volume, but if his mind swings wildly with every tick of his account, he will find this business far more expensive than it needs to be. Most fellows tie their confidence directly to their recent results. A few winning trades and they feel sharp as a razor. A short drawdown and suddenly doubt creeps in like fog over the harbor. Tell me, does the market really change that quickly? Or is it the trader's perception that is doing the swinging? Because the truth is, performance in trading rarely moves in a straight, comfortable line. Equity curves breathe. They expand and contract. They advance and retreat. That rhythm is not a flaw in the game. It is the nature of it. What gets traders into trouble is not the drawdown itself, but their reaction to it. When the equity line dips, the undisciplined mind begins to whisper dangerous suggestions. Trade more. Make it back quickly. You're losing your edge. And once those thoughts take hold, decision-making starts to warp. The trader stops executing his plan and starts negotiating with his emotions. That is when the real damage usually begins. A steady mindset acts like ballast in a ship. Without it, every wave feels larger than it is. With it, the vessel rides more smoothly, even through rough water. But here is the part many traders misunderstand. Emotional steadiness is not something you switch on during a drawdown. It is something you build in advance through process, through risk control, and through realistic expectations about how trading actually behaves. Have you ever looked closely at your own equity curve over a long stretch of trades? Not just the highlights, the whole picture. If you have, you already know it is rarely a clean upward slope. There are pauses, pullbacks, sideways stretches that feel like nothing is happening. That is normal. Yet when those very normal periods arrive in real time, traders often react as if something has gone terribly wrong. The professional approaches this differently. He expects uneven progress. He knows that even a strong method will produce clusters of losses. So when the drawdown arrives, and it always does, he does not interpret it as personal failure. He treats it as statistical weather, temporary, informative, worth monitoring, but not worth panicking over. That mindset alone saves more accounts than any indicator ever built. Now consider what happens when mindset and equity curve fall out of sync. When losses begin to feel personal, patience shrinks. Trade selection gets sloppy. Position size starts creeping higher at exactly the wrong time. You ever notice how traders often increase size not when they are trading best, but when they are most frustrated? That is the market exploiting human nature in plain sight. Keeping your mindset steady requires something very practical: predefined risk. If every trade carries a known, tolerable loss, then your mind has room to remain calm when things don't go your way. But if each position is large enough to make your stomach tighten, emotional neutrality becomes almost impossible. This is why money management is not just about protecting capital. It is about protecting psychological clarity. Another important point: your identity must never be tied to your last trade. The moment you start measuring your worth by your most recent win or loss, you hand the market emotional leverage over you. One good trade and you feel invincible. One bad trade and you question everything. That kind of instability is poison to consistent speculation. The seasoned trader builds a different relationship with results. He focuses on execution quality first, profit second. Did the setup meet the criteria? Was the risk defined? Was the exit handled according to plan? Those are the questions that keep the mind anchored when the equity curve wobbles. Because over time, and only over time, good execution tends to align with good results. There is also a quiet discipline in stepping back and observing your own reactions. When the account dips, what is your first instinct? To press harder, to revenge trade, or to slow down and reassess the market's character? Your answer to that question tells you more about your long-term survival than any backtest. Markets have a way of cycling between clarity and confusion. During the clear phases, many traders feel like geniuses. During the muddy phases, the same traders suddenly feel lost. But the tape has not singled anyone out personally. It is simply rotating through conditions. The trader whose mindset stays level through both environments is the one who preserves both capital and confidence. Because in the end, the equity curve is only a reflection, a lagging one at that, of thousands of small decisions made under uncertainty. If your mental state swings wildly with every fluctuation, those decisions will eventually deteriorate. But if your mindset remains measured, patient, and slightly detached from the day-to-day noise, you give yourself the one advantage most traders never fully develop. A losing streak tests discipline more than skill. Most traders believe the real exam in this business comes when the market is moving fast and the opportunities look obvious. They think the challenge is spotting the right setup, pulling the trigger at the perfect moment, and riding the move with nerve. But I will tell you plainly, the market rarely breaks a man during his winning periods. It breaks him during the stretch when nothing seems to work. When trades start failing one after another, the question is no longer whether you can read a chart. The question becomes much simpler and far more uncomfortable. Can you follow your own rules when the results are not immediately rewarding you? Because that is where discipline stops being a nice idea and starts becoming expensive to ignore. You see, skill is easy to trust when the market is paying you. Anyone can look calm and methodical when their last 3 trades were winners. But what happens after 5 losses in a row? What happens when good-looking breakouts fail and clean pullbacks don't follow through? Do you still take the next valid setup exactly the same way, or do you start hesitating, second, guessing and quietly bending your rules? That moment, right there, is where most traders reveal themselves. The undisciplined trader begins to negotiate with his plan. He skips trades that meet his criteria because he is afraid of another loss. Then, ironically, he jumps into a marginal setup out of frustration. Ever notice how that tends to happen? Fear keeps him out of good trades, and impatience pushes him into poor ones. It is not the market conspiring against him. It is his own lack of discipline showing up under pressure. A losing streak has a way of stirring emotions that winning periods keep hidden. Doubt creeps in. Frustration builds. The temptation to make it back quickly starts whispering in the background. That whisper is dangerous, because the moment you start trading to recover losses instead of trading your edge, you have already stepped off solid ground. The professional understands something the hopeful trader often misses. Losing streaks are mathematically inevitable. Even the strongest method, applied over enough trades, will produce clusters of losses. This is not a sign that your edge has disappeared. It is a normal feature of probability playing itself out. The trouble is, knowing this intellectually and living through it emotionally are 2 very different things. Have you ever reviewed your system during a calm weekend and thought, yes, I can handle the drawdowns? It always sounds reasonable in theory. But when you are in the middle of one, when the equity curve is slipping and the last few trades have stung, the emotional temperature rises. Discipline begins to feel heavy, and that is precisely when it matters most. One of the clearest signs of weakening discipline during a losing streak is subtle rule breaking. Not the obvious kind, the quiet kind, moving stops a little wider, taking profits a little earlier than planned, increasing size slightly to speed up recovery. Each decision feels small and justified in the moment. But together, they begin to distort the entire trading process. The market is very efficient at punishing that kind of drift. Another common reaction to losing streaks is system hopping. A trader hits a rough patch and suddenly becomes convinced the method itself is broken. So he searches for something new, a different indicator, a different time frame, a different strategy altogether. Now, adaptation has its place when market conditions genuinely shift, but constant switching during normal statistical drawdowns is usually just discomfort wearing analytical clothing. Ask yourself honestly, are you adjusting because the market structure has clearly changed, or because the recent losses have made you uneasy? Discipline during losing streaks also means maintaining proper position size. This is where many traders quietly sabotage themselves. Instead of reducing exposure during rough periods, they increase it, hoping to recover faster. That is not strategy, that is emotional math. And emotional math has emptied more accounts than bad chart reading ever did. The steady operator does the opposite. When performance softens, he tightens risk. He becomes more selective. He watches the tape more closely, not out of fear, but out of respect for changing conditions. He understands that protecting capital during the difficult stretches is what allows him to press when the environment improves. There is also a psychological muscle that develops when you endure losing streaks properly. Each time you follow your rules despite discomfort, your confidence becomes less dependent on short-term outcomes. You begin to trust your process instead of your last trade. That shift is subtle, but powerful. Because once a trader reaches that point, the market has far fewer emotional levers to pull. But most never quite get there. They let the drawdown rush them. They let frustration speed up their decisions. They start watching their P&L more than the price action. And slowly, almost invisibly, discipline erodes, not in one dramatic moment, but in a series of small compromises. Preservation of capital is the trader's first victory. Not the big win, not the perfect entry, not the trade that makes your account jump in a single afternoon. The real first victory in this business is much quieter than that. It is the simple fact that you are still in the game tomorrow with your ammunition intact. Most newcomers misunderstand this completely. They come to the market thinking the objective is to make money as fast as possible. They watch the charts, see the moves, and imagine themselves catching every one of them. But the market does not reward eagerness. It rewards survival. And survival begins with one principle that must sit at the center of your thinking: protect the stake. Let me ask you something. What good is the sharpest market insight if your position size is reckless? What good is a perfect setup if one bad trade wipes out weeks of progress? The market offers endless opportunities over time, but only to the trader who remains solvent long enough to take them. Capital is not just money in your account. It is your lifeline, your inventory, your seat at the table. I learned early that the big money is not made by being right all the time. It is made by being wrong small and right big. That sounds simple when spoken, but it runs against human nature. Most traders want to win often. They want the satisfaction of frequent success. So they hold losers too long and cut winners too quickly. They are chasing comfort instead of building durability. When you truly accept that preservation comes first, your entire behavior in the market begins to change. Position size becomes deliberate. Stops become non-negotiable. Trade selection becomes more patient. You stop asking, "How much can I make on this trade?" and start asking, "How much can I afford to lose if this is wrong?" That one shift in thinking separates operators from gamblers faster than any indicator ever could. Have you noticed how the market can turn without warning? 1 week trends run clean and smooth. The next week price starts chopping sideways, breaking out only to snap back. If your exposure is too large when conditions shift, the damage comes quickly. But if your risk per trade is controlled, you have time. Time to observe, to adjust, to wait for clarity to return. Time in the market is an advantage most traders underestimate, because consistency in this business is less about catching one spectacular move and more about compounding small, controlled decisions over long stretches. But compounding only works for the trader who avoids catastrophic loss. One oversized mistake can erase months of careful progress. The market is very unforgiving that way. Another thing worth understanding is the psychological benefit of protecting capital. When your risk is reasonable, your mind stays clearer. Losses remain information instead of emotional shocks. But when you allow trades to become too large relative to your account, every tick begins to feel personal. Decision-making tightens, objectivity fades, and once your thinking becomes emotional, your edge begins to slip. You ever notice how traders often perform best when they are trading small and worst when they are pressing too hard? That is not coincidence. A calm mind reads the tape better. A pressured mind starts seeing what it wants to see. Preservation of capital protects not just your account, but your judgment. There is also a strategic patience that grows out of this mindset. When you are not desperate to make money immediately, you become more selective. You wait for cleaner setups. You pass on marginal trades. You begin to think in sequences instead of single outcomes. The market favors that kind of thinking over time. The professional speculator understands something the impatient trader rarely accepts: opportunities are not scarce. The market will be open tomorrow, and next week, and next year. But your capital, once damaged severely, does not recover nearly as easily. That is why the first responsibility is always defense. Offense comes later, when conditions are favorable and your footing is secure. This does not mean trading timidly. It does not mean avoiding risk altogether. Risk is the toll we pay to participate, but there is a wide gulf between calculated risk and careless exposure. The trader who respects that difference lasts longer, learns faster, and is still properly funded when the market finally offers the kind of clean, sustained movement that builds real wealth. Because the truth is, the big winning periods, the ones traders dream about, rarely announce themselves in advance. They appear after long stretches of noise and uncertainty. If your capital has been drained during those quieter periods, you will not be positioned to take advantage when the environment finally shifts in your favor. And that is the quiet power behind capital preservation. It keeps you present. It keeps you patient. It keeps you ready while others are sidelined, frustrated, or starting over. The trader who treats survival as the first milestone is not being cautious for the sake of comfort.